Hello, everyone, and welcome to today's webinar brought to you by NetSuite. We are going to talk about the state of B2B growth, private and public company benchmarking and analysis. Today's webinar, as I mentioned, is brought to you by NetSuite, featuring Maxio and BenchSites. You will get to hear from some experts in the industry about SaaS growth and benchmarking, and I'm really excited to dive into the program today. My name is Liz Brigson. It's always a pleasure to be your host, and we really appreciate you joining us today. There's a few things I'd like to highlight to help you get the most out of the program. So first of all, we really enjoy your questions. We enjoy making these programs interactive. So you can use the GoToWebinar questions feature to say hello, let us know where you're joining from, and also ask questions as we go throughout the program. We'll make sure to take some pauses and respond to your questions. You can download the presentation slides from the GoToWebinar control panel. Today's program is 1 hour, so we will launch 3 polling questions, 4 actually. You'll want to respond to at least 3 of them to earn your CPE credit, and you can access your CPE certificate directly from your Incourse dashboard. If you're on LinkedIn, I'd love to connect with you, and it's always great to use webinars like this to expand your professional network. So I'd highly recommend following NetSuite, our sponsor company, and also following our presenters as well. I want to say a huge thank you to NetSuite for making programs like this possible. NetSuite has everything you need to grow all in one place. They have over 41,000 customers in 219 countries and territories around the world. They're the world's first company dedicated to delivering business applications over the internet. So what does that mean? They provide a full suite of cloud-based ERP services, and this includes financials, inventory management, HR, professional services automation, and omni-channel e-commerce. NetSuite believes that with unified information, every business achieves their vision. NetSuite is highly committed to professional education and to help every business achieve their vision. They bring together and cultivate this great circle of practitioners, consultants, and thought leaders. And so today's program, the state of B2B growth, again, private and public company benchmarks and analysis, features 2 thought leaders and experts in this space. I'm really excited for you to meet Randy Wooton and David Spitz. Randy is the CEO of Maxio. Randy has a ton of experience in technology companies, SaaS space. Maxio specifically is the leading provider of billing and financial operations solutions for high growth SaaS companies, B2B SaaS specifically. Prior to this, Randy served as CEO of Rocket Fuel. So you can tell growth is really a big focus and a feature here and a theme through Randy's career. And also he worked closely with Percolate, leading into this content marketing platform before its sale. Previously, Randy held senior leadership roles at Microsoft, Salesforce, and also several startups. So really, as you're listening and you're learning from Randy today, know that Randy has explored these topics, he's led these topics, he's led companies, he's been part of large organizations and also startups. And I think that breadth of experience from startup all the way to large global enterprises is just a really neat profile to learn from. David Spitz is the founder of BenchSites, and he led the SaaS investment banking practice for Pacific Crest Securities before it was acquired by KeyBank. And that was a role that he had for over 20 years, so long tenure there. He previously led the software practice at Soundview Technology and began his career at CS First Boston. David has also had an extensive experience in the SaaS space. He's been part of numerous SaaS transactions, including IPOs for Salesforce, ServiceDay, Workday, Viva, HubSpot, Twilio, Slack, Zoom, UiPath, and DigitalOcean. You probably recognize many of those companies. So really excited to learn from 2 gentlemen, both of you who just have this experience of large company, small company, really all about SaaS tech growth. And we're really excited to learn from you today about the trends in the B2B SaaS space. So Randy, I'll turn things over to you.
Well, thank you, Liz, and thank you very much to NetSuite, the sponsor, and for you all for hosting. It's really a great privilege to be here. And thank you for everyone who's attending. We look forward to the conversation. Looks about 120 people on the call, and that's just great. And also thank you for the kind introductions. Dave has been one of the luminaries in SaaS metrics. Is one of the people I followed, and when I started at Maxio two and a half years ago, he was recommended to me by my investors at Battery Ventures to go learn about SaaS, and we've been in touch for those 2.5 years and had lots of provocative conversation. Dave writes really great stuff on LinkedIn. I really would encourage everybody on the uh, on the webinar to follow him. He's going to help frame. Let me see if I can get this thing to work. So we're going to do a couple things. One, we'll start off with a polling question, but broadly what we're going to do is we're going to talk about public company dynamics, and that's Dave's sweet spot. He spends a lot of time throughout his entire career looking at public companies, trying to understand public companies, helping to get funding, driving deals, and so he has continued that in his career today. So we'll talk about public companies. He'll use the metrics that he has developed through BenchSites, his company, to help frame that. We'll do another polling question. And then at Maxio, we have about 2,200 customers that we aggregate anonymously that data. So it's private data of what's happening in terms of growth and year-over-year growth and by pricing model. And so we use the data from the Maxio report to help inform that. And then Dave and I will have a little back and forth around public versus private company, and then lead into, if we have time, the 2025 trends. I mean, it's the month of trends. Everybody has forecasts in January, and so we'll have a couple we'll talk through. But of course, we will reserve time at the end for Q&A and be happy to answer any questions throughout the webinar as well. And so with that, I think, Lisa, we're actually going to start off with a polling question to get us going.
All right, that sounds great. We'll go ahead and launch the first polling question. And that question is up on your screen now. Which growth challenge is most pressing for your organization? So would you say that would be scaling operations, increasing profitability, attracting, retaining your customers, managing costs, or other? If you respond other, feel free to let us know in the questions box what other represents for you. So thanks everyone for getting going and clicking in your responses quickly here. We have close to 80% of the audience who has submitted responses. We'll give you all about 10 more seconds. So which growth challenge is most pressing for your organization?
This is super fun. I'd love seeing
It
the
really
real-time
is.
participation.
Impressive.
The good news is that, David, it's sort of lined up with what we're going to talk about. If
It
it
is.
had been the other way, it would have been like, whoops, maybe we got to do a different webinar.
Although it's interesting, I would have thought scaling operations would be number one.
Yeah.
So we're covering all this stuff, but growth has just been such a challenge as we've seen. Oh, maybe I've just
You just gave it
prompted a few
away,
people
Dave.
to vote for it.
You just gave it
Yeah.
away.
No, I think managing costs is going to win.
Well,
All
let's go
right.
ahead and take a look at the final results here and share them with everyone. So it does look like managing costs is the leading response, but each of these has a really good cohort of people who are with us today who are committed to understanding and hopefully tackling these challenges. So let's close the poll and dive in.
Yeah, and just so quick, Dave, as you look at the poll and the results, any quick observations from that before we go into the data?
Well, like I said, I think the biggest overriding struggle right now is growth. So, I mean, we all have to care a lot about costs, but I've seen other polls over the last 6 months or so, and I've consistently seen scaling operations being the top thing. So maybe things are shifting here. Don't know. I
Yeah,
certainly pay a
or
lot of
you know,
attention
some
to
of,
cost.
some of the some of the questions that I saw, controlling costs and then profitability, and then I think
Yeah,
that also leads into scaling operations. It's that tension you and I have been chatting about for the last 2 years in terms of uh, growth at all costs versus efficient growth. So I
yeah,
think there's some dynamic there, which we'll see through the data. So maybe let's
yeah.
move into
They're
the
all interrelated, as we know.
all interrelated. Yeah. So why don't you give an overview of bench sites and then I'll
Yeah,
be your
let's start
banner.
with this slide. Yeah, and thank you, Randy, for inviting me to do this, and NetSuite, who I've worked with before. So it was a really like I didn't hesitate. This is something that was going to be super fun to do. I was unaware of this, and hopefully this will be enlightening to folks. So I just wanted to set the stage. So what I'm going to do is talk through over about 10 slides the metrics that we're seeing in public companies. And anybody can grab these metrics. There are about 80 public companies that are SaaS companies, and of course they report every quarter. And so in many ways, unless you're Maxio and you get a view on 2,000 private companies, it's going to be the best place to get a sense of what's going on in the market. And bench sites. So I started bench sites about 3 years ago. as was mentioned earlier, I was a banker for many, many years, worked with a lot of companies. And really during the heyday of SaaS, which I still consider it to be the heyday of SaaS now, but we now, in the early days, let's say, when Salesforce went public and when NetSuite went public, nobody knew like what was good or great or mediocre performance because A, there weren't that many companies, and B, you just didn't have a view into what people were doing. And even today, as you look at private companies, you just, if your churn, meaning, the amount of customers, the amount of dollars you lose in a year is 10%, uh, or, if your NRR is 110%, nobody really has a good sense of whether that's good or great or bad. Just because, of the thousands of companies, you just don't get a view into that. And so you can look at the public companies and get some sense, and as I say, there are about 80 of them now. But if you're trying to get a view across the thousands of private companies, it's very difficult. This is what inspired me to build bench sites. So what we've done is created, it's almost like it's a data repository, but it's also an application that you can interact with and get a sense of what your metrics are versus the benchmarks out there, whether it's public companies or other private companies that are part of our community. So we just released this application in the last month and a half, and we're building a database now through investors, through companies coming directly to the site. I've got the website up here. It's free to use, and ultimately you get to look and see across about a dozen metrics, things that we'll cover here, things like what's your growth rate, things like what's your NRR, which is a retention metric, your GRR, how efficient are you, how profitable are you? These are the types of things we're looking at, and we not only help you compute your own metrics, but we give you the opportunity to compare them with other companies and especially public companies. And so what you see on this page here on the right is a view of basically the waterfall, which is how you really start by computing your metrics. If you look at your ARR a year ago and you compare that with your ARR today, you can see, for example, what your growth is. But the important thing in doing the benchmarking is to say, well, how do I compare with my comparables, or how do I compare with the public companies? And so in the middle of the page here, what you see are these filters. We've got 8 filters, and the one we're going to use today in looking at looking at the benchmarks is the one that's labeled ownership. And so you can go to our site and generate these charts yourself as long as you become a member and basically provide your own metrics confidentially. We're going to go through over the next few pages and basically review what the benchmarks are for public companies, but you could just as easily do this for security companies or for companies over a certain size, and et cetera. So, but today we're just going to look at the public companies because that's the task at hand that we've been talking about. So Randy, if you could advance to the next slide, I'll just walk through this.
One thought, David, on that is, so I've been, in SaaS when it used to be called web-based ASP. Like literally, I came out of business school in 1999, and we were doing cloud-delivered software and that operating model of paying for it out of OpEx versus CapEx. And throughout those entire 25 years, we've always wanted to try to figure out, how are you doing relative to the others? Because you don't have a big set of customers, you don't have an established market. And so I think what you're providing here is a real service to help all of us operators who are trying to do our fiscal year planning right now understand if our growth for next year is aggressive but achievable compared to what's been happening, or are we just out of whack in terms of what we think might happen. And that's what will lead to some of the predictions as we go forward. But I think a really good starting point is the public company, because they have to report accurate financials. And so let's pull back the curtain a little bit. What's been going on in the public company growth?
Yeah, well, I mean, no big surprise here. What you see is a falling knife, if you will. The growth rates, I mean, this is not news to anybody that's been paying attention. Growth rates have just come down pretty dramatically since 2021. And, a lot of people would argue 2021 was a bit of an aberration. Growth at any cost phase of the market was certainly in effect back then in the COVID environment. But still, the growth rates that we're seeing today, this is among 82 public companies, sit at about 17%. That's literally cut in half from 2021. And by the way, if you took this chart and went back 5 years or even went back 7 years, you would still find that that 17% growth is about as low as it's been. This is again the median. It's across about 82 companies. Obviously, in each period, it's a different number, but it's a big enough number that we can feel pretty confident. Like this is a trend. Like this isn't. There are some companies, of course, that have bounced back. This doesn't mean the chart. This is the chart for everybody. And of course, there are plenty of companies that are growing faster than 17%, but there's of course plenty that are growing slower. The important point here is when you see something like this, that's a pretty clear trend, you can't ignore it. Like this is going on for everybody. We'll see it in the private numbers, not to steal your thunder, Randy, but and of course, a big question mark is, well, how, when you start breaking this down, what is driving it? And I don't think we have complete answers to that, but there are some basic answers that we do know, and then we can also kind of slice and dice the results. But make no mistake, like this is setting the table for really everything else that's going on, the efficiency, everything else. It starts here with growth, and also make no mistake, like this isn't voluntary. This is involuntary. Like these companies have been faced with this over the last few years in a way that spending through it isn't going to solve the problem.
Yeah, and I think one thing we saw just even 2 years ago was this just across the board price increase. I think Salesforce just came out and said we're raising all of our prices by 9% because they weren't getting the growth from selling more. They had to focus on monetization. And so I think this has led to things we'll talk a little bit about in terms of efficiency, the layoffs that we continue to see play out from the crazy year of 2022. But yeah, so you have the high level growth is getting to this average, but really the other thing is this net revenue retention. Maybe
Yeah.
explain to people who may not know what the number is or how you calculate it, and then what the trend is.
Yeah.
'Cause this is pretty
Yeah.
significant as well.
It is. So first, the definition, good point. And actually, if you go to our application, you see this very clearly, both the definition and you see the effect. But just to explain it in plain English, net revenue retention, this is a metric that I would say about 2/3 of the public companies report. It is a measure of how fast your existing customer base is growing net of the churn. So obviously, in any particular year, some of your customers may be lost, some may just reduce in size. All those things impact this net retention number. And then, of course, to the extent some of your customers expand, that will be accounted for as well. So, for example, if we look at that 110%, that's the median net revenue retention, sometimes it's called net dollar retention, that we see currently. What that means is that if you looked at your existing customer base a year ago, and then looked at that same base, not including any of the new that you sold to, the net increase from that base grew by 10%. So net revenue retention is a number that is going to be typically centered around 100%. 100% would mean no net growth. If it's 110%, that existing customer base grew by 10%. So that's what that is. And before I pause here, the meaning of this chart is basically saying, look, for the companies that do report this metric, about 55 companies, the growth from existing customers has gone down from 22% growth a few years ago to 10% growth. That's the way to interpret this. So it pretty much has mirrored the chart that you saw on the previous page. Basically, growth from the existing base has been cut in half, meaning that also growth from new customers has probably been cut in half as well.
And one of the things I've seen, two things that at play there. One is broadly, I don't know, 2 years ago when everyone was like, oh my God, I can't get growth. Everyone shifted to, well, let's go focus on custom marketing and try to drive, because you have the SPA in place already. You already have the relationship. You demonstrated some value. And the thought was, in terms of efficacy of spend, it would be easier to get your current customers to buy more stuff. And I don't think that's played out that way. And the other thing is, the other trend that I've experienced is this relentless focus on internal software spend. And that, so if we're all SaaS companies selling to each other and we're all trying to pull back in terms of what our spend is, that's going to affect both what's bought new, like what
Yeah.
new software you sign up for, and what you're willing to spend. The third trend, I guess, is with the cutbacks in headcount. You see, number of salespeople go down. Guess what? They need fewer Salesforce seats. So I think you have these broader trends that are contributing to the what we're seeing in the deceleration of growth, but also very specifically in NRR.
It is a vicious cycle, or it can be a vicious cycle, and it's certainly been one. I will say, just in terms of what you just said about it being easier. Well, easier is probably the wrong word, but less expensive to get an expansion versus getting a new customer. I think that still holds true. Like, and we actually see it. We don't have it in this particular number, but we do see that typically you're going to spend a lot more uh, through your sales and marketing efforts acquiring a new customer versus getting an existing customer to expand. But the point is here, it doesn't mean it's easy, and it's gotten harder, obviously. And there's only so much expansion you can expect from the existing base. And unfortunately, that level of expansion that's available to you for most of these companies has really come down quite a bit. So it's really
All right.
important. Yeah.
So
Okay,
now
so
as you
this is
think
a
about,
little more detail, but
yeah,
yeah,
go ahead.
this is going to mirror some of the stuff that Randy's going to go through later. One of the trends we're seeing in SaaS, and we've seen this for a while, is more and more companies are saying, look, we're not just going to charge you a subscription each year and have that be constant. We'll provide you essentially a pricing model that varies with usage. And so among the public companies, just to pick an example, because it's the one that everybody likes to cite, and a very successful company, although they've struggled a bit more recently, is Snowflake, where essentially you pay for the storage and compute that you use. Even Amazon Web Services, frankly, is priced this way as well. Whereas a lot of kind of traditional companies like, let's say, Salesforce or even NetSuite, our sponsor, typically it's not usage-based. But usage-based is becoming more and more popular. Buyers like it in some ways because if they don't use the product, they're not paying as much. CFOs don't tend to like it as much because it tends to be a little more unpredictable. Um, and of course, with the usage-based pricing model, what you see is things can go up or down, any day or certainly any quarter as we're measuring these things. So one of the big questions everybody has about this is, well, is it better? Is it better on your financial metrics? And how are these companies doing relative to some of the key metrics that we track, some of the key benchmarks that are important to us? Growth being the prime one, we're going to start there. And what we see here is on the left here, and so this, I'm sort of demonstrating what our product does here, but you can go in and basically set a filter for companies that are usage-based pricing models. And so on the left here, what we've set is the filter saying if more than 50% of revenues that are coming in to the SaaS company are perceived to be usage-based, then that group is on the left here. And if you're curious as to which companies are part of that, it's all on the bottom of the page. So you see companies like Snowflake is in there, Twilio, Cloudflare, Datadog. These are companies, by the way, like these aren't set in stone, but this is our sense of these companies. And I've spent some time with people who really have a good understanding of these companies, and that this is where we've come out. And you can see, so that's the left side of the page, and you see that's dropped from 54% growth, which is obviously incredible. That's the median growth in 2021, and that's dropped to 22% most recently. So it's come down significantly. On the right side of the page, these are the companies with less than 10% usage-based pricing revenues as part of their SaaS revenues. This has come down in a similar percentage, as in like cut in half from 28% to 15%. And so when you look at these two, you say, well, they look in some ways similar. Certainly they've come down by similar amounts, but the drop was much more precipitous, just in terms of point percentages, for those who are leaning in heavily with usage-based pricing models. Presumably, it'll be easier for them to bounce back. We don't see that. We're starting to see it a little bit, but we don't see that just yet, which actually, frankly, surprised me. I would have thought we're starting to see the environment improve some, but still, those companies still haven't bounced back quite as much as you might think. So again, not to steal Randy's thunder, but he's going to spend some time on this as well.
Yeah, we'll pick that up and talk a little bit more in detail. But okay, so then as we move on to by category, so as people define themselves, because one of the things about benchmarks is you really want to be focused on end market as well as try to think about ACV size and
That's right.
flows, like trying to get as much specificity as you can. This is one dimension in which you could look at. So what are you seeing on this front, Dave?
That's right. So, this is early in the development of our data, frankly, because once you start slicing the data like this, N, meaning the number of companies in any particular group, gets smaller. So this is our hope, and hopefully there'll be a bunch of people coming out of this webinar who say, I want to get a little bit more information here, and also I'll put my data in. And so this is really just the public companies. We do see, not surprisingly, security companies. They've been among the strongest. Vertical SaaS has been very strong as well. These are companies that are growing the fastest currently. These are the most recent growth rates. Whereas companies in the communication ERP sector, not growing as quickly. So everybody loves to see charts like this because they can fit in where they sit and see how they do against these benchmarks by category.
And so, Dave, we got probably like 4 or 5 minutes left for the public
Yeah.
company. If you want to go through the private and the Q&A.
Let's just go through the other ones more quickly. So I'm
Okay.
going to hit some of these other metrics. So profitability is up significantly. Obviously, that coincides with that polling question earlier. People care a lot about this. If you're growing less, presumably you can cut headcount, and that's been happening. And the market has definitely demanded that these companies get more profitable if they're not going to grow as quickly. And what we've seen is that level of efficiency associated with profitability, whether you look at this one, free cash flow, or EBITDA margin, I don't have here, but it looked very, very similar. It's up significantly. So that certainly is something the market has appreciated. But let's just click through to the next one. So this piece of it, though, is the piece that's lagging. I'm not going to spend too much time, but my LinkedIn, I talk a lot about this. The issue that we have with go-to-market efficiency is these SaaS companies, basically, what you should be paying for when you're funding sales and marketing is the change in ARR, because presumably you should get renewals at a reasonable rate. This is the whole concept of recurring revenue. And what you should be paying for in your sales and marketing, your go-to-market efforts, is basically net new ARR. And given that the growth has collapsed, yes, there is somewhat less spending as a percentage of revenues on sales and marketing, but when you make that really important comparison, which is how much are we spending versus how much are we getting in terms of net new, that is a pretty ugly picture that really has not, it has gotten progressively worse pretty much every quarter. And it's something that really needs to be fixed here. What this is saying is that $2.04, the most recent, the dot all the way on the right, that's basically saying that companies on average or on median are spending over $2 in sales and marketing expense for each $1, in net new ARR. So higher is worse. So we could just advance to the next. Yeah.
And just one sort of trend on that. At Maxio, we're in a super competitive environment at the low end, competing as a billing solution. Our price per keyword for search keyword has gone up 4x in the last 2 years. It's like the price of gas. You can't change it, but you got to put the gas in the car to drive, but you got to get your head around like, well, are there other ways to do marketing more efficiently? How do you get in front of prospects? But in a world where you have fewer people in market, more competitors competing for it, it's supply and demand. And so how does that play out in terms of the different pricing models?
Yeah. So there's a lot to consume here, especially given the time left. But basically, we've looked at this across, just as we did for growth. We've looked at it for companies that are usage-based pricing models. That's what you see on the left here, versus companies that are more traditional subscription models. And we see the problem is it is net higher, as in more costly to do it as a subscription. So usage-based pricing is more efficient, but both of them have been impacted over the last few years.
Dave, do you
That's
think part of that is, I often think of subscription models, it's not totally true, but the pricing models being coinciding with a go-to-market model. So a subscription model being more a sales-led model, having more salespeople in that overall sales and marketing expense, whereas usage models, a lot of the PLG, product-led growth companies lead with usage-based. So it's less sales and marketing. You do have to spend
Yeah.
marketing on it. Sometimes you could say, but wait, you're spending all this money on product to acquire people. You should attribute some of
Yeah.
those dollars. But do you find that to be true in terms of the go-to-market model being reflected in the pricing model in large part? And that might be what's playing out
It,
here as
it
well.
is definitely a possibility, but I think it's still TBD whether the PLG, because I've seen research that says, PLG is not cheaper. And when I think about, I don't know, salespeople at Snowflake, they're still pretty heavy in sales. Like, they do a lot of sales-led growth. It's not a PLG model per se. I mean, yes, you can use it, but those things are not necessarily synonymous. So I think it's still TBD. These particular numbers and the fact that sales-led is definitely higher cost it is really something that needs to be explored further. But I wish I had the answers, and I don't yet. The last thing everybody loves to talk about, of course, is like, well, what about valuations, at least among the public group? And so what you see here on the left here is basically a chart that looks at growth rates and bucketizes the 80 companies by growth. And of course, faster growing companies do trade at higher valuations. That's something that's not surprising to anybody. And we see it in the medians here. And this is something that a lot of people basically will glom onto for good reason. On the right side, just looking at that go-to-market efficiency metric that we were looking at before, there's also pretty good correlation here between companies that are the most efficient from a go-to-market perspective, that is spending less, that less than $1.50. Those companies are also trading at a higher level. So there is a definite correlation between go-to-market efficiency and valuation, kind of similar to the growth side. But if you turn the page, more and more people, there's something called the rule of X. And rule of X it's kind of the succession of rule of 40. The concept of, hey, let's look at growth and profitability together and make some assessment of like those companies that really are doing the best from a growth perspective, but also doing well, not sacrificing profitability. So if you're growing 40%, but you're losing money hand over fist, those companies aren't going to be rewarded as well. Whereas this rule of X basically says, hey, let's look at growth and actually let's weight that growth by more, because growth is more valuable than profitability. So this notion of 2 times growth plus the free cash flow, let's look at that. Let's look at that percentage, if you will. So if you're growing, let's say 20%, and you're generating 10% free cash flow margins, that would be that 20% times 2, so that's 40%, plus the free cash flow margin, another 10%, that would be 50%. That would be that middle bar there. And so that's what this chart's doing. It's a lot to think about, of course. You can see all the companies on the bottom that make up each of these bars. But here, the correlation is actually even quite a bit higher than it was for just growth or go-to-market efficiency. It's close to 0.4, which that's a pretty good R-squared for something like this.
And in some ways, it's logical, especially for public companies where people are betting on the future profits, right? The future earnings when they're valuing companies, that growth is going to be a driver. But I think we see that across the private company as well. So Lisa, I think we're ready for our next polling question.
Okay, that sounds great. I'll go ahead and launch the second polling question. Which metric do you prioritize most when assessing company growth? So, for those of you in the audience, just a point here to reflect on the metrics you're using when you're assessing company growth. So, would that be your top line, your revenue growth rate? Would that be looking at customer acquisition cost, customer lifetime value, profitability margin, or other? While you're all responding to that question, Dave, I wanted to follow up and ask you a question. So you talked about go-to-market efficiency, and it sounds like there are companies out there. Did I hear this right? They're spending $2 for every dollar in recurring revenue.
Absolutely. I mean, there's some spending $4 or $5. So absolutely. Yep.
So if we have time, like how is that calculated and how is that kind of dialed in? I imagine every company has their different tolerance around the funding and what they can do. But can you break that down for us just a bit further if we have time?
I can. It's kind of a mouthful. I don't want to steal too much of Randy's thunder here, but essentially what you do is you look at how much you spent on sales and marketing. Typically, it's over a 12-month period, so you'd look back by 12 months and take that number. That's the sales and marketing number. That's the go-to-market spending number, and then you'd look at your ARR from a year ago to current. Different ways to get that, but that's essentially what your clip of recurring revenue is. And so it's very simple division, really. It's just taking that sales and marketing number. So if you spent $2 million and you grew ARR by $1 million, that would be the $2.
Awesome. Well, thank you so much. We like our calculations here in the formulas. That's super helpful. Let's see. So we've closed the poll. We're sharing the results, and we can see that revenue growth rate here is a leading winner, followed by profitability margin.
I think
Perfect.
that's kind of consistent with what we're talking about. Is that it's this growth, it's efficient growth. You got to have both growth and efficiency. The one that surprised me that was so low was customer acquisition costs, because that is another way of thinking about the metric that Dave talked about. Customer acquisition costs can be split into two: your new CAC and your expansion CAC, and you focus on your sales and marketing dollars that you're spending for every customer. That's like a proxy, a unit costs. It's similar to the sales and marketing for overall ARR. So definitely worth following Dave online as he talks about those sales and marketing efficiency. I know every single board meeting I have, I'm talking about those metrics, specifically new CAC and expansion CAC, and how much are we spending next year to get the ARR we expect. So I'll spend a couple of minutes on the private company dynamics. For people in the audience, we publish what's called the Maxio Institute report. Every quarter, we aggregate, as I mentioned, we're a system of truth for about 2,200 customers. We take that data, we anonymize it, we roll it up, and then we publish a report that captures what's happening on a growth rate. You can download the latest report with a QR code. All the cool kids have QR codes, or you can go to our website, maxio.com. We actually have our latest one is going to be coming out in the next couple of weeks, which we'll share on the website. So when we think about the state of the private market versus the public market, guess what? Similar trends are happening. Growth is strong, maybe even a bit stronger in the public markets because you have a lot of early stage companies with lower revenue, so growth is more apparent, but it's slowing. The smallest startups are growing again, which if you've been following us, you'll know that actually companies less than $1 million really struggled about a year ago. We can talk a little bit about that. There is the gap in pricing model that Dave was pointing to between more subscription versus usage-based term versus usage is closing as well in the private market. And we've seen some change in the investors. So hopefully we'll get to that in the time we have left. We call it the funding trifecta of what you need to be great to get that funding to hopefully lead to the path of going public one day. So similar to what you saw with Dave's analysis, in the private companies, what you've seen is this reversion to a mean. It's not to what it used to be prior to the pandemic. I would say that in general, we have thought of before I started this company in 2020, when I was another company, 20%, north of 20% was sort of the minimum threshold to be considered high growth. But now we're finding the average is normalizing around 16%. What There's growth going broadly across industries and sectors. We won't get into too much of the industries today, but to Dave's point about how he split out the different industries in our growth report, we have similar information. The big difference is, Dave, you're able to do in real time through his website. Ours is aggregated data that we present every quarter, so you can use both tools as you're building your business and trying to do your planning. So small businesses, as I mentioned, if you look at this as the blue line, is small businesses, which we define less than $1 million. Most of our customers are between $1 million and about 40 million. We definitely skew mid-market and below. We do have customers that are pre-revenue and customers that are 100 million, but Dave's data would also probably skew more towards the larger customer base, those that are public, right? They have their earnings and be able to support being public and the predictability in the revenue. So we're much more skewed to that lower end of the market. And what you saw was this just break in the early stage companies. So it's less than $1 million because they hadn't gotten escape velocity in terms of their revenue, the replicable sales model, and the VCs all pulled back. I remember talking to my CEO friends back then. It used to be you raise money every 18 months. What a bunch of VCs said was, well, that money we gave you, they're supposed to last for 18 months. Now it needs to be 36 months. And the operators are like, wait, what? That wasn't my burn profile. And so we saw a bunch of companies burn out. Now a bunch of new companies got started, and that's why I think you see out of the ashes of that meltdown, the explosion we're seeing in the most recent year. And similar to the trend that Dave's talking about, the larger B2B firms that we see are experiencing a modest slowdown. The final factor that Dave and I didn't talk a little bit about is part of this was just the access to capital and the cost of capital. Is when the interest rates went up, guess what? People, like for us at Maxio, we used to not really even think about what our interest rate was and how much we had to generate in cash to pay the interest because it was so low. Zero interest rate environment, and all of a sudden interest rates became a real deal, and everybody from the operators to the investors to the bankers to the LPs started thinking about, oh my God, what is the cost of capital? Well, that's starting to come down again. And so now you're starting to see the funding environment loosen up. We'll talk a little bit about that.
Randy, that jump from 7% to 26%, is that largely driven by a lot of these newer companies, or have some companies really turned it around?
100%, Dave. And I think that is one of these major, who's getting funded is all the AI native companies. Like, I did AI back in 2015, and now everyone comes out, they have .ai in their name trying to get the funding. But you see it in terms, I think, all the other reports. Where's the funding going? It's disproportionate funding this new wave. And those are the people, we have a bunch of them as customers that are just taking off now. So this is similar to the slightly different perspective because he had two charts. I have one chart, which is fixed rate companies, those that are setting up a yearly fixed rate pricing model versus the usage base. What Dave's points were spot on, though, in terms of in a volatile market, people stop spending and the usage base may go down, right? You start to see your usage contract, whereas in a high growth market, you start to see it go up. And you love riding the wave of the expansion, you're fearful of the volatility. So the only thing I'd underscore that Dave had mentioned was your ability to forecast usage is really hard to do. And that's why what Dave said, CFOs don't like it, is because you can't take the pattern, the historical trend and say, oh, we saw 4% growth last year, we'll just make it 4% growth next year. You got to be looking at like what happened last month and think about, do you multiply that by 12 or you take the trailing 3 months or you break it out into cohorts. So it requires a lot of extra work on behalf of the CFOs to figure out what to do with usage-based forecasting. So then if we think about the funding trifecta, when we looked at all of our data, there came down to 3 characteristics. So much like Dave's guidance around the rule of X, which we all love, right? There's always some new metric that you can use to define success. If you look at the funding environment, those that are growing the fastest from our data set have had 3 characteristics. One is they've reached at least Series B. So for me, this is kind of like they've got product market fit, they've hired a salesperson, and they're starting to get a replicable sales model at Series B. Series C is where you really are scaling that. Number 2 is they've raised $10 million in funding. meaning they've been able to demonstrate, and that corresponds with Series B pretty much, but it helps you, you're going to have cash in the bank. And if you've been good stewards of that cash, you're going to be able to weather the storm. And then the last part, I think, of the trifecta is you've raised within the last 3 years, because you're at good valuation. If you raised prior to that, it was crazy valuations, and trying to grow out of that or grow into those valuations and raise more money becomes really hard. So let me pause here before I show the data. Dave, you've been a long time banker. Does this strike you as new, or is this consistent in terms of like who's getting the money and who would grow?
Yeah, I think these are great. This is a great set of filters for figuring out who's doing well because, funding, especially in this environment, like in 2021, this probably wasn't the right set of filters,
Right.
honestly. But in the environment that we're in, it's a litmus test, and the litmus test is if you're able, because there are a lot of companies that people think of that are quality companies, but maybe they're not growing as quickly. If they're private, nobody gets to see that. This is a this is a good way to filter out the ones that are actually working, because even if a company has a great name, if they're not growing as much, it, so I guess the other thing I would say is this isn't necessarily cause and effect. Like
Correct.
it might be that the companies that are growing faster, it probably is. It's a virtuous cycle here. The ones that are growing faster are getting the funding. So to say it's cause and effect is probably it's probably not quite right. It's a virtuous cycle. And of course, they have to still pass the test afterwards after they raise that they can still grow and grow in an efficient way. So, yeah.
Yeah, I mean, that's a fair point. It's sort of like saying, well, gosh, if you have more sales and marketing efficiency, you're going to have higher value multiples in the marketplace. Yeah, like no duh, because you've been able to demonstrate that you can drive growth, and that's what people care about. And so I think you're absolutely spot on in terms of not causal, but indicative of
Indicative.
companies that
Yeah.
are primed for success or ones that are about to take that next step. So
Yeah.
this is a little confusing. We try to make it as simple as possible. Along the bottom, you'll see the different, the key for the different quarters. Each bar is a different quarter. Those are all grouped by what funding round they are. So those that have received later funding rounds have often grown more quickly than their early stage counterparts. And so I do think, the insight here is if you're taking VC money or you move into PE money, like understanding your capital structure and your plan for capital, like what I was mentioning before, like are you getting enough for 18 months? Or are you getting enough for 24 months or 36? Is critically important for you as the CEO and CFO to be aligned with the board. It used to be this adage of T2D3, triple your growth rate in the first 2 years and double your growth rate in the next 3 years. T2D3, you're taking that money and there's going to be follow-on capital to support that. I think that has changed in terms of the expectations of growth. I think it's changed in terms of what investors are looking for. Any thought on that, Dave, before I go to the next one?
Well, the one that's just staring at us here is the one all the way on the right, the Series D plus with that dark blue, really
Oh yeah,
high.
fair. Yeah, great. Yeah.
That's just like that is really interesting, and it'll be fascinating to see if that continues. So I'm like on the edge of my seat, waiting to see like what that's going to look like in Q4.
What I don't know, Dave, is, and I'll look at it for our next publication, is what the N is of that specific cohort, and maybe a little skewed because Series D are the really big companies, and I mentioned we are, mostly $100 million and below, but we do see that. Okay, so let's go to the next one. So firms that have raised at least $10 million have experienced approximately 8% higher average annual growth rates than those that haven't. Um, and as I was saying before, I think the insight for me is there seems to be a critical mass where most B2B companies need a planned way to get to the 10 million in funding to be successful. And you think of these thresholds, like your first dollar, your first 100,000, and then I think the next threshold is kind of like $1 million, right? And that's founder-led sales. You probably have some friends and family, or angel round investments. But when you start to take private money and you're running up to the 10 million, actually very few companies get there. But what's your observation about that threshold of $10 million and between 1 million and 10 million? And Does this surprise you in terms of growth rates being tied to inflection points of scale?
No, I don't think so. I mean, this is kind of what I would expect. I think, we're still trying. I think, as you look at each tier, like you look at the 6 to 10 or 10 to 20, right now you're not seeing, like, you're seeing some noise in each of those, like they're going up, they're going down. So it's hard to come out of this and say, for each of these groups that there's some overriding trend. Obviously, the companies that have raised more um, do look healthier, so that's actually somewhat comforting. Um, but I think, like, the temporal trend, as in, like, are things getting better or worse? I think it's still TBD when you look at this. Like, you just don't know, because you're seeing them go up and down in a particular quarter, but not necessarily heading in a specific direction.
I think
Um,
you're right. I think sometimes there's this feeling if you raise a lot of money, you don't have a great business model, you're just burning capital. The flip side of that is you've raised a bunch of money and you're the category leader. We all know that disproportionately the profits of an industry go to the category leader. And I think that's part of the mythos of investors is get in front of the people that's going to be the category leader, give them a bunch of money, and they go grab market share. So I don't know
yeah.
what's playing out there specifically, but hey, given where we are with the time, I do want to get to the trends and have a little bit of time, and I want to make sure that people are able to get to all four polling questions. So, Liz, would you mind launching the next polling question, and then we'll do trends, and we'll wrap up with the final polling question.
That sounds great, Randy. Here's our third polling question. What is your company's primary growth for the next 12 months? So, what are
Hmm.
your plans, your company's primary growth goal? Would that be to increase revenue, improve operational efficiency, expand market presence, enhance your product offering? So, of these options, please let us know. What is your company's primary growth goal over the next 12 months? Great polling question for January. We got a nice calendar
Yeah,
year.
totally. I was just thinking about that. I'm working on my operating plan with my team and working on the budget with my board. And what they say is increase revenue and reduce costs. I'm like, thanks.
Got it.
But I
That's
think this
why they
more in
earn the big
line
bucks.
with your comment earlier, Dave, that you saw through other surveys, a lot of people were focusing on growth versus the scaling operations. This seems a little bit more in line with what you were describing.
It does. Of course, the question is, like, your growth goal, so it's all about the growth, but, increase revenue however you can. I think that's fair.
Great.
I think if you had the enhanced product offerings and put, like, the initials AI in there, that would have bumped it up a little bit.
Yeah, that's true. And the question is, well, where are you going to get the revenue from? Like expand market presence. Well,
Exactly.
that could be, are you going to another market? That can be really expensive. Are you going to another segment? Going from mid-market to enterprise sales? Well, that's really expensive. If you need to go adjacent capabilities, are you building in new capabilities that are AI powered? Everyone's
Yeah.
looking. I mean, we
Yeah.
are. We have a system of record
You
of
have.
data, and we're trying to move from workflow automation to
Yeah.
intelligence engine. But building the data lake and building all the API gateways is like really hard and requiring significant investment. And so that trade-off, that capital allocation trade-off is what CEOs, CFOs, executive teams have to really focus on. What's your Horizon 1 versus Horizon 2 strategy? There's no one right answer, but making sure you've got alignment with your board and relative to what's happening broadly in the trends in the marketplace. And so with that, let's go to the last um, have we gotten out of the dark ages, what I call the hidden B2B SaaS recession, and are we in a new future? And there's lots of data out there. This one from Morningstar shows that we're starting to see a reduction in GDP growth rates through the rest of 24 and into 25 with a turn of growth. What are you seeing in terms of how, as you look at all the public companies and the expected forecast and their earning forecast, like what's baked into that? A good economy or too soon to know because of the change in
You
administration?
know,
What are you
so,
seeing?
the data that we see coming in, of course, is all, and this has been a criticism, but of course that's just the way it is. It's rear view. It's looking at the last quarter, the last year, the last 12 months reported. And of course, we saw those charts. They're flat. Well, they've come down, but they've kind of flattened out and stayed down. You don't see, it's not in our app, you don't see the forecast in there, but none of these, and of course, at the end of every quarterly call, the management team will project. They always like to beat and raise. So when things do start turning around, you don't see that until it actually starts happening.
Right.
So, but my own personal view is, I think M&A is going to come back with some fury here because the regulatory environment is going to loosen up pretty considerably. So I think that's probably going to help. I think there are going to be some opportunities to grow faster that weren't there. I don't think we're going to see anything dramatic right away, but I do think that at least in the short term, we'll start seeing more activity and therefore, more buying activity.
That's great. And this last chart is actually from Crunchbase. I don't have it updated through Q3 or Q4, but it'll be really interesting to see what this is showing you is the equity financing by VC-backed companies. Dave was talking a little bit about M&A, but the total drop-off in total number of deals, which we were talking about earlier in terms of mostly impacted probably by Fed rates, uncertainty, market uncertainty. We're starting to see a bit of a pickup in terms of total dollars spent, even though the number of deals has continued to go down.
Yeah.
So they're looking for good deals, and those good deals are the ones we talked about earlier, right? They've already got Series B, they raised $10 million in funding, and they did it less than 3 years ago. And so I think you're starting to see this, at least right now, this concentration around the winners are going to continue to win. And maybe if the Fed rate goes down more broadly and things loosen up, we'll see more activity. So the recommendations at the very highest level are, accelerate your growth initiatives. Dave and I were just talking about that. Where are you going to focus? Make your bets. Strengthen your investor relations. Ensure you're aligned with your investors around what current reality is, what they're seeing broadly across their portfolio, what their expectations are for you in your end market. Using things like Dave's benchmarks insights to help you understand that really helps. And then reassess your pricing strategies. So that is one where what we find is companies are not just fixed rate nor usage, they're actually both. And it's that hybrid model and understanding which products are going to be driven by value demonstrated through usage-based versus other ones where you have more of a platform play can really benefit. And so with that, let's just go to the last polling question, Liz, if you don't mind.
That sounds great. We'll go ahead and launch the fourth and final polling question. What do you find most useful when benchmarking? So would that be industry-specific comparisons, size-specific comparisons, regional comparisons, or all of the above? I think what I'm hearing about bench sites, Dave, is that you've created it so you can really slice and dice and set those filters to see each of these comparisons.
Yeah. We've got 8 different ways to slice it, and of course, any combination. So, literally thousands of ways to look at it. You can set multiple filters independently.
Excellent. Very good. Well, thanks everyone for clicking your responses in very quickly. I'll go ahead and end that poll, share the results. Combination seems to be by far the leader here.
Yeah, and I think that's great guidance as far as both Dave building out his software and us trying to do our analysis. So Liz, thank you very much. It's super helpful. We have a minute left. I saw there were 2 questions. I don't know if we want to try to crank through those. Michael Reese, maybe if you're still interested in asking your question, what can we answer something for you?
Yeah, while we're waiting, and we do have just a quick minute left. It's been fascinating, and just like the pulse that you both have on the SaaS environment is just really fabulous. Randy, for anyone on the call who is a finance leader and is dealing with SaaS subscription revenue, can you just, talk just for a brief minute here about what Maxio can do for the CFO to make finance's life easier? I think that would be a really great thing to hear as we get ready to close.
Well, great. Well, thanks for the advertisement. I'm happy to take it. So Maxio is a billing and financial operations software. We help you do the billing in support of your pricing motion. So if you're doing subscription-based billing, subscription as a service, that's the broader industry. The key there is when you're doing subscriptions, you got to think about rev rec and reporting. How are you actually recognizing the revenue and reporting it? And it plays out for CFOs. Any of you finance people out there are going to know about deferred revenue and ARR waterfalls and the wackiness that can happen when you start to try to do that all in Excel. So we really help people make sense of the madness and run their companies more efficiently and get funded and stay funded.
Awesome. Well, thank you. And thank you so much for that snapshot summary. We are out of time and would love to continue the conversation, but we know everyone has probably places to be. This has been fabulous. Thank you to NetSuite, Bench Sites, and Maxio for making this possible. For the audience, I know you'll want to just hold on for a couple things. First of all, you can access your CPE certificate directly from your in-Corsa dashboard. So please go ahead and find that there in 1 hour. You can access the handouts from your Corsa dashboard, and then also later on today we'll upload the recording. So if you want to make sure to share this with your colleagues and just consider it, and if you want to listen through it again to hear these insights, you're welcome to find that recording later on this afternoon. When you close GoToWebinar, the course survey will pop up on your screen, and we always appreciate your feedback. So thanks again to our great presenters, Dave and Randy, and we'll look forward to having you all back with us again very soon. Until then,
Thanks, guys.
take care.